Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased today to welcome back our returning guest, Ronnie Stöferle, Managing Partner of Incrementum AG. Ronnie, as always, thank you for joining Sprott Radio.
Thanks for having me, Ed. Always a pleasure.
Well, first of all, Ronnie, let's get an update on how you've been doing personally and also what you've been working on over at Incrementum.
Currently doing two big things. I'm preparing for a marathon, which is going to be in 3 weeks. It's my third marathon, and the older you get, the harder it gets. But on the other hand, I'm feeling really well prepared, and that already leads me to the other marathon that I'm currently working on, which is the In Gold We Trust report.
Oh, yes.
And I can tell you it's the 19th edition now. I'm doing it for 19 years. And it's probably never been harder to solve this 3D puzzle that's going on, because everything is so turbulent and volatile, and it's crazy. But then on the other hand, the good thing is that gold really did a tremendous job over the last couple of weeks, especially when volatility picked up in markets. So there's going to be quite a lot of topics to analyze, to discuss, to research. So my days, basically, I'm starting at 5 a.m. I'm writing, I'm researching, I'm crunching numbers, talking to the team, and then I'm going for a big run at night. So that's my life at the moment.
Perfect. Well, people can't see this, but you look fantastic. You look healthy. You look great. So I wish you the best for the marathon, for both marathons, of course.
Thanks, Ed.
Let's talk about the volatility because to me, I would have thought you would have started by saying, well, we're taking a bit of a victory lap here. Gold is doing great. It's staying above 2,900. We're really happy to see its performance. But you said it's really quite hard. It's quite, a lot of things going on. So talk a bit about that, what gold's doing, the volatility. Give us kind of a recap of 2024 and work your way into 2025, if you would.
Sure. So let's start with the numbers. Gold was up 26% in US dollar terms. It was up 38% in Australian dollar terms, 37% in Canadian dollar terms. Even in the Swiss franc, which used to be by far the hardest fiat currency, up 35%. In euro terms, 34%. So it's been a great year for gold. But if you change the perspective, you could say that basically every fiat currency devalued by roughly a third versus gold, which is quite dramatic from my point of view. So last year's In Gold We Trust report was called the New Gold Playbook. And I think that basically described what's going on in the gold world, in the world in general, quite well. So we are actually seeing that gold doesn't really react to old patterns like the inverse correlation between real yields and the gold price. It seems to be that it's history for now, because back in the days, if you would have seen real yields rising dramatically like last year, you wouldn't expect new all-time highs in gold.
Mm-hmm.
So central banks are one of the most decisive factors, and that's especially central banks from emerging markets. I think that's really important to understand. The second thing is this weaponization of fiat money that basically started with the confiscation of Russian reserves in 2022. That was definitely a wake-up call for wealthy private individuals, for many emerging market countries. And of course, it has effects on real estate in London, in New York or Vancouver, that used to be like the preferred savings destinations for emerging markets capital. But I think this has really changed, and gold has become a new safe haven for that kind of money. Then we're seeing that there's some sort of a monetary climate change. That was also a title of a previous In Gold We Trust report. So monetary policy isn't as important as fiscal policy anymore. I think that's really one of the key takeaways. Last year, the United States had a budget deficit of roughly 8%. Of course, on a relative basis, that makes a huge difference compared to China and to Europe. And that basically explains why the US economy did so well over the last 2 years. So I think, there's this bull market in gold is standing on a very, very strong foundation. And this foundation was mainly driven by emerging markets demand. Now, this year, I would expect that Western financial investors will at some point come back. We're already seeing when it comes to the gold ETFs that it has stabilized. There were actually some inflows in the second half of the year, but I think this is just really getting started. And a friend of mine on LinkedIn once said, there's probably more people in the United States that believe that Elvis is still alive than people in the US holding physical gold. So I think there's quite a long way to go. And of course, this is all driven now by this enormous amount of uncertainty that we're experiencing in this world. You're waking up and you see like crazy new headlines. So I think
Hmm.
investors, markets, equity investors especially, they just hate this uncertainty. And that's, I think, an additional driver for the price of gold going forward.
Let's start with policy. There's been a lot of movement in policy here in a very, rapid pace. What's your take on that? What kind of foundation is that laying for gold going forward in your view?
Well, and I'm not a political analyst. I'm just a small gold analyst. And all those geopolitical movements that are happening at the moment, it's just so complex. So I think it's even too much for people doing nothing else than trying to understand political developments. But from my point of view, I think what's really interesting for capital markets is that I think Scott Besson said that recently that the US is headed for a detox period.
Hmm.
Now, it seems that the last couple of days have been quite turbulent in capital markets. Just yesterday, which was Monday, 10th of March, 1.75 trillion were wiped out from US markets. So, of course, there's all paper wealth, but it has an effect on consumer confidence, on spending behavior. So, I think if that detox period that probably has just started, if that continues, it will have major impacts on capital markets, on equity markets, on currency markets, on the bond market, and of course also on the gold market. Now everybody is kind of hoping for this Trump put, but also Scott Bessent said recently there's no Trump put anymore, but there's a Trump call upside. I thought that was a pretty interesting comment.
Yeah.
We are already seeing now in Europe with Friedrich Merz announcing that Germany will actually get kind of rid of the debt brake, and Germany, which was basically the capital of prudent fiscal policy and how shall I put it, conservative government finances, they're basically making a U-turn saying, well, we'll invest roughly 500 billion into infrastructure and 400 billion into defense. And that had major impact on the bond market. So if you have a look at the 10-year bonds, which used to be kind of the gold standard for fixed income investors in Europe, it went through the roof. I think it was the biggest loss for bonds since the German reunification. So a big move. The signal for countries like France, which is from my point of view the biggest threat in the eurozone, but also for Italy and other countries, is definitely a very strong signal. Basically saying, well, okay, let's do what the United States did recently, very Keynesian fiscal spending, trying to stimulate the economy, don't care about debt levels and debt limits anymore. So this obviously will also have a tremendous impact on the gold market. If I would put it in a nutshell, it seems that there's some sort of a relative shift in fiscal policy. So while the United States seems to become with Doge and this detox period more hawkish and trying to get rid of those enormous budget deficits, on the other hand, China and Europe are running significantly higher fiscal deficits, and I think that's basically the main reason for this enormous shift in capital markets. And let's not forget, I mean, there's still a very one-sided positioning in many global mandates. The US, I think, has a 37% weighting in the MSCI world, while the Eurozone accounts for just 8%. So I think this reversal of flows will probably continue in capital markets.
And you talked about the fiat devaluation in in 2024 in the US dollar. That has traditionally also helped gold. And if you hear kind of what the policies are out there, what's your take on that? If you think about the US dollar relative to other currencies, do you think you're going to see a continuing weakening of the US dollar? And as you talk about the new playbook, will that continue to help gold going forward?
We've seen enormous strength in the euro recently, and the Dixie index is very heavily weighted towards the euro. But we're also seeing the Japanese yen showing some strength. And Japanese yields are rising, and the yen has risen dramatically. So Japanese savings are a very, very important factor in global financial flows. So when the yen rises, Japanese savers tend to repatriate capital. And I think, again, most importantly, probably is that European countries are now set to run much more stimulative fiscal policies. So I could see the euro doing better over the next couple of quarters, which doesn't mean that it's fundamentally a buy, but it's all relative. However, I think, if we crunch numbers versus gold, you can see that the average rise in gold in various currencies is pretty much the same. So over the last 15 years in US dollar terms, on average, gold was up 7.2%. In euro terms, it was up 8%. So you can basically see that fiat currencies are being devalued versus gold. And then the fiat currencies versus each other, that's a relative game. That's like the least dirty shirt kind of game, where I would say that, still the Swiss franc probably is, from a fundamental basis, the strongest fiat currency out there. But I would say that the strength in the yen and the euro could continue based on capital flows. And I think Donald Trump, but also Stephen Mirren, who's a very, very interesting man. He's the chair of the Council of Economic Advisors. And also Howard Lutnick. They've been quite vocal saying that the US dollar is too strong. They want to have US manufacturing celebrating some sort of a renaissance. And therefore, I think they will try to get the US dollar down. We've had the Plaza Accord, and now they're openly talking about the Mar-a-Lago Accord.
And are you seeing gold really kind of return as an alternative currency? You talk about fiat currencies being devalued relative to gold. Is gold really having its hat thrown in the ring and just saying, "Hey, we're a currency also. Let's buy oil and gas with gold, not with U.S. dollars, with other currencies." Is that actually happening, or is that just more anecdotal as far as how people are thinking about gold?
Ed, I'm traveling quite a lot for business, but also with my family. And I've been in Saudi Arabia this year, attending one of the largest mining conferences, spending lots of time in Dubai, in Turkey, and or if you talk to Indians, for them, gold is money. I mean, there's no discussion about that. So it's a very Western view that gold is kind of coming back because for the majority of our people, it's never been not money. But what I think is super interesting, Ed, is stuff like, auditing Fort Knox, stuff like revaluing gold, stuff like gold-backed bonds. This has all been like topics that were discussed, on Zero Hedge, and, the usual suspects on Twitter discussed that.
Right.
But now it's becoming mainstream. And Luke Roman, I mean, I found out about him through my friend Grant Williams many years ago, and he was like only like macro nerds knew about him. Now he's speaking about gold with Tucker Carlson. So this stuff is really becoming mainstream, and I think it's super interesting. But then it's also, I sometimes feel like, if you know that feeling, if you really love a band, which is like kind of a newcomer band. It's like an upcoming band. And then at some point, they become more commercial and they are being played on the radio and everybody likes them. So it sometimes feels like that. We put out our 2020 report where we said it's going to be a golden decade. And we announced our long-term target, which was 4,800 US dollars. Back then in 2020, people said, "You're crazy. What are you drinking? What are you smoking?" And now it seems like people say, "Well, it's still on the high end, but it could happen." So I think there
Yeah.
was a major shift when it comes to sentiment. It's being more more accepted again. So let's put it that way in sports terms. I think we're somewhere in the beginning of, let's say, the third quarter, something like that. We're not like at the very end of this game, but it's definitely not.
Yeah.
Gold is not a contrarian play anymore like it was a couple of years ago. It has become more mainstream. You can see if you have a look at the research reports from the big banks, they're all becoming slightly positive now, but they're not going crazy yet, like in 2011, where every bank had a super bullish price target out. Based on a Dow theory, we're in the so-called public participation phase.
I love that comment, public participation, because every year all the big bank stuff come out and the gold is always a predicted price, and it's always lower than what it's currently at until last year. So the world is kind of waking up to it. And to your point, I would say we're maybe at halftime, not even in the third quarter yet. It does seem like a foundation has been set and the world's waking up to it. And the fact that it's being talked about at cocktail conversations, and it's just more people are talking about it today than they have in the past. I mean, I've been with Sprott for almost a decade now, and I've even noticed it, just the general acceptance of it today versus even just 4 or 5 years ago. So that seems to be happening.
It has become more of a cocktail thing that is being discussed, but the majority of people actually say, Jesus, why didn't I buy like when it was trading at 1800 or 2000? Now it's too late. It's already too expensive.
Great point. Well, and that's when we started this podcast today. I said, I thought maybe you'd be taking a victory lap, but at 2,900 plus, it sounds like a lot of more work still has to happen. That there's a lot of runway with this still, and so for those investors saying maybe I missed it, well, maybe they missed it when it was at 1,200, maybe they missed it at 1,800. It continues to kind of do its job, and I think that's the message we try to continue to convey to our investors. You're investing in its ability to add value over time. And I think that's really the message. I think people get caught up too much on price and they forget the value and the productive aspect that gold has in a portfolio. How do you convey that to clients as the price is rising like this? How do you get them to understand that it is a smart, valuable, low cost, liquid way to diversify a portfolio? What would you say to someone today that says, hey, I missed the move. I should have bought it a year ago or 6 months ago even?
Well, I think it's always best to let the numbers speak for themselves. That gold is an excellent portfolio diversifier. Gold works really well during recessions, and perhaps the gold market is kind of sniffing that out, that a recession is on the horizon. Gold works really well in times of rising inflation. I think inflation volatility is something that we should expect going forward. Gold does tremendously well during times when there's geopolitical crises, and gold works really well as a dollar hedge. And I think that alone should make a strong case for gold. We also know that gold usually works really well in times when equities correct big time. So I think from a portfolio diversifier point of view, it totally makes sense. We put out the special paper. It was a little bit academic, but we crunched the numbers and asked the question, what is the optimal gold allocation? Now, we all know that investment or asset allocators, investment advisors, on average, hold like 1 to a maximum 2%. So that's first. The second thing is, I would say, of course, on a nominal basis, we've seen quite a move in gold. But then on the other hand, have a look how the debt situation has developed. Have a look at monetary aggregates, how they exploded over the last couple of years. Have a look at the S&P 500. Have a look at house prices. Have a look at other asset classes. So I would say on a relative basis, gold isn't super cheap anymore, but it's far away from being extremely expensive. That's the second thing. And then the third thing is, from my point of view, every big bull market, and we're really in a bull market, and you can tell that because every little correction is being bought. What this tells me is that there's an enormous amount of capital waiting on the sidelines because they have missed the gold party. And normally, what performs best in this parabolic phase of a gold bull market, it's obviously silver and the mining stocks. And so far, They have basically, their performance has basically been in line with the price of gold, but they haven't massively outperformed yet. So therefore, I would say, in sports terms, again, somewhere like halftime, beginning of the third quarter. I don't understand baseball too much, so I don't know which inning it is.
We'll call it like the fifth inning, sixth inning,
Okay.
maybe somewhere around
Okay.
there. Miners, let's stick with that for a second because it's been a head scratcher for a lot of people. The price of gold continues to go up. The price of silver is showing strength. The margins are expanding and people aren't paying attention. The quality of these companies are there. The dividends are strong. They're doing all the right things, but the market's really not paying attention yet, I guess is the best way to say that. What's your take on miners right now? What's happening with the mining space?
If you have a look at relative charts, and I think in a world that is also being driven by monetary inflation, I think relative charts give you a tremendous amount of information how markets actually develop, and how they are building up relative strength or weakness. If you have a look at, for example, a chart of gold miners versus the S&P, or gold miners versus the tech space, the semiconductors, you can see that they're actually, they're breaking out from a long bear market. If you have a look at the relative strength of gold versus the S&P, you can also see that gold has built up an enormous amount of relative strength versus equities. So gold is now outperforming bonds and equities, which is really important, and also basically every major currency. So that's a sign of a strong bull market. When it comes to equities, I mean, just have a look at the results, really the numbers that the mining companies, the well-run mining companies, are producing at the moment. They're free cash flow monsters. And we've already seen, that the Fed started lowering rates, but it's been a bit different compared to previous cycles. But if there should be like a larger pivot, I had a look at 2001, for example, during the dot-com crash. The S&P was down 18%, gold was up 20%, and the GDM index, the mining index, was up 177%. The same goes for the time after the financial crisis, 2008, 2009. Miners were up 122%. 2018, we all remember that when the Fed reversed course, they halted QT and started cutting rates. The mining stocks were up 50%. The COVID response, 2020, mining stocks were up 104%, and they significantly
Right.
outperformed not only gold but also the S&P. So I think, you've got great fundamentals. You've got a technical setup where gold is holding up really well, where gold is in a pronounced bull market. You've got generalists slowly coming in, and I think that's a pretty good setup for the mining space going forward.
So it's fair to say you like the miners.
It is.
The work you do is so awesome, and we appreciate you certainly continuing to educate us. When can we expect this year's report to come out?
15th of May is the big date. We will be publishing the report, as always, in English, in German, the compact version also in Spanish and in Mandarin, and for the very first time also in Japanese. Japan, it has become a really interesting gold market. 22 people are working basically 24/7 on this report. I'm just one of them. It's a great team, but again, it's really challenging because there's so many things going on at the moment. Of course, we want to write a report that, if you just read one report a year about gold, it should be the In Gold We Trust report. So that also means it has to be interesting, or it shouldn't be outdated if you read it like 3 months after publication date. So that's the challenge that we're facing, being, addressing all the things that are going on at the moment, but then also not forgetting the longer term perspective. Yeah, 15th of May, that's a big day.
Well, I still love the hard copy. I dog ear it throughout the year, and I actually save them, which is maybe that makes me a nerd, but I save all the old ones.
Will actually be available on Amazon for the first time.
I love it. I love it.
We are now able to set it up on Amazon so everybody can order the printed copy.
Well, when you start doing them in leather bound books, we know we've hit a peak in the market. What have I not asked that you want to leave the listeners with? What should people be watching for the rest of this year in 2025? What should they be concerned with? Any one or two little clues for the newer listener or the newer investor in gold? What should they be paying attention to as we go through the rest of this year?
Somebody on Twitter just wrote, the last 2 years were make money years. We're now approaching don't lose money years. I think that perfectly sums it up. I think it's going to be a really volatile ride. I think there will be huge opportunities in the mining space. There will be opportunities in the silver space, also in commodities. But it's not going to be an easy year. And I always make that analogy. So, being from Austria, skiing is my favorite sport. So, when the weather is fine and you've got great snow and the sun is shining, everybody is a great skier.
Right.
But when it's icy, when it's foggy, when it's steep, then you can really differentiate if you're a good skier or not. And I think this year for money managers, this will really separate the wheat from the chaff. That's what we're being paid for. I mean, that's our job. That excites me, to be honest.
I love it. Well, Ronnie, it's always a treat to have you on. It's a crime that we haven't physically met in person yet after all these years. I suspect at some point that has to happen. But thank you as always for making the time, and get back to work on your training and get back to work on Gold We Trust. And we're looking forward to the May 15th rollout.
Thank you very much, my friend. Take care.
Thank you. And thank you all again for listening to Sprott Radio. I'm your host, Ed Coyne, and thank you for your time.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.